Jose Manuel Campa, the chairman of the EBA, is with us, and I'm absolutely delighted to have Jose Manuel with us for the second time. The first time now after COVID. We had our conference just before the significance of COVID really became apparent. And it's very interesting to hear, I think, a little bit how the thinking in the EBA has evolved around issues of technology. And so, Jose Manuel, I'm delighted to have you with us. And maybe I start with that question. How do you see, COVID having changed the way you look at banking and payment services and the supervision thereof?
Well, first of all, good afternoon, and thank you for having me. Can you hear me okay?
Perfectly.
Perfect, very good. And thank you for the question as well. I should say, it's hard to believe that a year has passed since the last conference we had in Brussels. I think it was one of the final events in person I attended in person before the COVID-19 crisis. And a lot has happened in the last 12 months. I think from the EU financial sector, it has implemented significant changes to facilitate remote customer access. I think we can also say that the response to this crisis, particularly in the early stages of the crisis, was robust, and banks in particular, but the financial sector in general, was able to provide adequate services. I think regulators, supervisors, central banks, and generally authorities showed that they could work at a pace to deliver measures to support the financial sector. Now, from our perspective, some of the work that we have been working on, like the guidelines on ICT and security risk management, have proven more crucial and timely than we ever thought they were going to be. We also took some decisions, for instance, in the area of payments that we just discussed before, on the use of contactless payments by extending the existing exemption from strong customer authentication up to a maximum threshold of 50 euros per transaction, something that then the countries, the member states picked up, and the industry responded positively and was implemented quickly in a way to allow customers to limit their need for physical contact at the point of sales terminals. So I think there's a lot of progress that was made. I think looking more broadly, beyond the crisis, like it happens in many of these situations, the crisis has shown that some of the underlying trends in the industry have accelerated. And as a result of that, we have also seen very important policy initiatives from the European Commission Digital Finance Package, which I think is very important, but also in line with the Green Deal and the new industrial strategy for Europe that the Commission has. So I would say that if you asked me 12 months ago where we're going to be today, I sure would not have been able to guess it.
That's true. Yes, it was, I think, one of the very last conferences in Brussels, and it was a pleasure that you were with us in person. Hopefully we can do it in person again next year.
So.
And by the way, yes, thank you very much for the action you took on contactless payments. I think it was a very quick and effective move, which I think many of us have appreciated in the interim. Maybe moving on a little bit. I mean, you've looked at in the last year a lot at kind of the impact of scaling of technologies. It's not just about introducing and testing technologies in the market, but we're reaching a point where certain technologies are reaching a scale and size of activity that they will start to be adopted en masse or in a more significant way by many of the companies you're supervising. Be that in the crypto space, which we just talked about. We're all awaiting a number of announcements fairly soon, be it in cloud, be it in some of the other technologies. So how have you been thinking in the last year about the quicker adoption and scaling up of technologies by financial institutions and banks in particular?
Yeah, thank you for the question. I think that's a very important question because to me, it shows a huge opportunity for the European Union, because it would take as a starting point that we have the largest single market in the world. And if we're able to harness innovative technologies effectively so that they can scale up to that large single market by improving consumer access to financial services and also unlocking new ways to channel funding to EU businesses, particularly SMEs, through innovation, I think boosting this digital finance can be seen as an essential tool to supporting the EU economic recovery and the economic transformation that we're engaging in. So I think we need to leverage on the full potential to be gained from those technology-enabled changes. But at the same time, obviously, for us, from our perspective, we need to be also effective in mitigating risks. For that, into doing that, I think that the first thing we need to do is to have a mindset in which we are conscious that we need to overcome inadvertent and new barriers to scaling. Whether those stem from the current regulatory approach that we have, from our supervisory stance, sometimes I think from skepticism from the top regulators because of lack of knowledge on those technologies. We need to work on that, and we need to be neutral in the way we approach them, and timely. I think it's very important that we're timely in being able to address and understand those new risks. So for me, this entails that we proactively monitor the developments, we investigate potential issues, and report on risks, like we've been doing over the last 2 years when we see in areas of innovation, where potential risk, we issue an opinion, we send this opinion to the Commission, to other relevant agents, and that then gets taken on into potential regulation. Now, if you allow me to, I think there are 2 areas in which we need to be careful when we will scale that. One is we need to be able to better pooling our knowledge and expertise across the Union. And here we have worked very actively with we created the European Forum for Financial Innovation, and there we exchanged practices with industry, and that has worked out very well. We also have at the EBA, the FinTech Knowledge Hub, that has, via our website, people have access to new innovations that are taking place, and we have also enhanced our training for supervisors or regulatory authorities across the Union so that they are capable of having, as I said before, a more knowledgeable approach to these new technologies. The second area I think we need to react also is, as I said before, we need to be better at having timely assessments of risk as they develop. And I think that's important that we continue to monitor this carefully. I think that as the landscapes evolve for the next few years, we will see obviously new technologies come into place, different uses for those technologies. It's very difficult to assess risks about technologies that you don't know that they exist or that you don't know how they would be applied. So that's where we need to keep that agility to understand the applications quickly and then to be able to do risk assessments also relatively fast.
If I come to your latter point, Jose Manuel, I guess you might have in mind things like artificial intelligence, because I think I'd be interested what your thinking is a little bit around that, because it's an area which I think is being applied more and more, not yet in really critical functions within the financial service sector, but it's being used in risk assessments, it's being used in aggregating prudential data, in client handling, and all kinds of other use cases. But normally, artificial intelligence, if really applied, means that the machines will learn, that they will adapt, that they base themselves on the models. So how do you interact with, as a supervisor, with an increasingly complex environment like that?
Yeah, that's a good question. I mean, I'm glad you asked me, because our current focus is very much for this year is on the issue of artificial intelligence, and if I may add other ones of digital platforms. But in the specific issues of artificial intelligence, I think that it's clear that this is a technology that's offering a very transformative potential in banks, and we're observing a growing trend towards the adoption of artificial intelligence applications all around the sector. And I think COVID-19, as I said before, is one of the instances in which the COVID-19 has accelerated that trend application. We did a risk assessment report in last December, and according to this report, 64% of EU banks have already launched some AI applications, and they expect that 12% of the banks expect that within 2 years they'll move from pilot testing to really full implementation of these applications. And the range of applications is very large. We see it across all sectors of the value chain. For example, from increased customization of services to customers, back office processes where efficiencies can be generated, reduce error rates, AML, customer onboarding issues. There are many areas. Compliance, obviously, in general, it's an area in which this happens. Now, as we go, I think that this offers a lot of opportunities, but we need to know that also there are a number of challenges of the progression of AI, particularly in the way that data management is being done. I think that's one of the top areas in which we need to be concerned about. Others related factors such as integration, how does AI technology integrates with the legacy IT systems and the existing IT systems in the banks, along with, as you know, some serial potential ethical considerations of how AI applies, having to do with explainability. And that's why in the report that we issued late last year, we were talking about some, principles that we should agree upon on the application of these technologies. But we will be coming up with a report at the end of this year on the way we see, AI being deployed across the banking sector and some of the potential regulatory implications for that.
And we're going to speak to DG Connect later this week also to see how it fits within the AI strategy, the horizontal strategy that the Commission is working on. Maybe one follow-up question on that is because AI is so closely linked to access to data and sharing of data and having access to pools of data. And it's also closely linked to, computing capabilities, be it through cloud computing or otherwise. How are you thinking about kind of the infrastructure, the data question, and also just the infrastructure issue around facilitating AI? And how does that feed into some of the work you've been doing on outsourcing?
Yeah, thank you very much. I mean, as you say, the data issue is become a very important issue, and I think we heard this morning the Commission also going with the idea that we need to move beyond open banking to open finance. There was a significant process that was made in PSD2 on the management of data across the financial sector, but I think we need to continue to work in that direction. As you say, and as we continue to go forward, part of the challenge that we have in technology, and it's not just on data, it's in other parts of the value-added chain. It's basically that there is a redefinition of the value-added chain. In many products, there is a fragmentation of the value-added chain, and we need to assess what the risks are being generated in there. Whether that fragmentation can be interpreted just as arm's length transaction, outsourcing, or other forms of third-party engagement, and whether there are specific risks linked to that is something that needs to be assessed for the different products. And I mean, we're going to be looking at this year with particular interest. The Commission is launching a call for advice to the three ISAs in this area as well. But I always reflect back on the analysis that we did 2 years ago when we're looking at the, as I mentioned before, the ICT guidelines, and we're drafting the early stages of those ICT guidelines. And there we identify significant risk of outsourcing to cloud providers, and we issue an opinion to the Commission on that front. And the Commission actually acted, and now we have the Digital Operational Resilience Act, which will help us address that from the regulatory perspective. So I think that we need to continue making those assessments. We need to realize that the technology is redefining value-added chains, fragmenting them in some ways, consolidating them in others, and as a result of that, we need to do the proper risk assessments to make sure that the system remains robust.
Thank you. And you've also answered a question that came from Javi from BBVA exactly on this third-party provider point. I mean, moving on to another point, which is how technology might change the structure of banking. So kind of the nature of banking, we talked actually in a session just before you joined about disintermediation and the impact of disintermediation through new technologies. How do you think technology is transforming kind of the community that you're supervising?
Yes, I mean, as I mentioned before, and I was listening to the previous section as well, and I heard your last question about how many payments providers would there be 5 years down the road, and I heard the response, which I thought was very interesting. I think that the challenge, as I said, for us, the way we view now is twofold. The value-added change is being redefined. In some products, in some parts of the business, implies fragmentation, further fragmentation of that value-added change with new players, with new definitions of what are the different products provided by some of them. In other parts of the value chain, we actually see the opposite. We see more consolidation, bundling of products, platformization, or the creation of platforms. Excuse my poor English. The creation of platforms, and that's another issue that needs to be analyzed. So I think that those are obviously engaging as a result of that in different kinds of potential financial stability risks, potential operational risks that may be different. And we need to assess those and make sure that we have the proper regulation for that. I already mentioned the call for advice from the Commission to the ISAs, and the issue of fragmentation. Another section of that call for advice will also ask us to assess this part of platformization, which I think will be important.
Yes, and by the way, platformization is, I think, neither an English word nor anybody else's word. And I don't think it existed a few years ago. But
it's a virtual word in this virtual world.
Yeah, we have to get used to all these new terms. No, but if we look at the role of platforms, it's a big issue. We've got the Digital Services Act, which doesn't formally include financial services, but we've got debates around the role of platforms. in the value chain, as you say, the distribution model changed. Things, rules you have around product oversight and governance, around marketing, around distribution, all those conduct rules you've put in place together with the other ESAs. I mean, it's too early. I know you still have to do the analysis. You still have to get the call for advice from the Commission. But how do you see this development around platforms? How do you see some of the issues that from the perspective of the three ESAs and the EBA in particular would be of particular interest or concern to you?
Well, as I say, one of the key issues for us is, well, this in principle with the platforms, what we expect is that maybe a reaggregation of financial services, on the digital platforms. Now, these platforms obviously will offer many opportunities for obvious probably assets of choice for consumers, and particularly in our context of the single market through the cross-border provision of services, which will value this as a positive outcome. But some risks may also arise, and you were pointing to some of the risks that are there. At least potentially, and they need to be analyzed. Risk of conduct, risk of potential lack of competition, risk on limits to competition that there may be coming forward, and also on potential concentration risk. That some of them may be traditional, let's put it this way, concentration risk on liquidity issues, but also some of them that may be non-traditional because we don't know yet the services that may be bundled together. In addition, there may be in some of these platforms the tendency to try to provide traditional banking services, particularly think about lending and non-bank lending to these platforms, and that's one aspect that we need to make sure that we assess properly, and who is providing potentially that non-bank lending and what the systemic consequences of that may be.
Yes, because you're right. I think we see the trend more and more moving from payments into providing some form of credit provision, either to the merchant side or as hire purchase consumer credit contracts to the customer side. And I think we'll move quite quickly, and we discuss that with Gabriel tomorrow, into the non-life insurance space. Where do you see the regulatory framework? I think part of the interest of our conference is always the parameters of regulation and the parameters of oversight. You mentioned operational resilience. It's brought it into focus that we will now most likely see you becoming the overseer for some technology companies that interact with banks, but are not regulated themselves, are not supervised themselves. When it comes to customer-facing activities, it becomes even more of an issue, because in the insurance space, we at least have the insurance mediation directive for these brokers in between. In banking, we don't have, well, we have a bit, but it's not quite the same framework. So how again, it's early, but basically, put it differently, going forward a few years from now, you might become the overseer of all kinds of technology companies for all kinds of different things, or we see the license regimes incrementally being extended. Where do you see kind of the limits of the EBA's responsibility in all of this?
Well, I that's a fair question, to be honest, and it's an open question, as you very well posed. I think that we have being confronted with this challenge that technology allows us, as I said before, to break the value-added chain, to introduce new players in different parts of the value-added chains, and that sort of leads to a natural response, which is say, well, we need to move maybe from entity-based regulation to more activity-based regulation, and that's absolutely fine. And I think that that's absolutely correct. And I also heard the commissioner this morning, and you heard her as well. And it's a statement that I will agree with. In cases, like that, basically same activity provided by the same but different entities with the same risks should require the same regulation. Well, that's an approach that I think is valid and is true, but it's quite different from the traditional approach that we follow. I mean, I am the chair of an entity that's called the European Banking Authority. So by definition, it refers to entities which are called banks, and it's not the only, but has been traditionally at the core based of our regulatory mandate. As we go forward, as you say, if we move more into more activity-based regulation, we might find ourselves in a situation in which we are regulating for a number of entities that are beyond traditional banks, more and more probably technology firms. That happens already, for instance, in the payments area, in which we have some mandate in payments. Of course, but the question arises, who will be supervising and what is their need to supervise the implementation of those regulations by the proper follow of those regulations by those new entities that are not under supervision. And that, as we go forward, this active debate, we're now starting with more some activity-based regulation, and the proposals on DORA that have been put forward by the Commission is an example of that. Of course, some of these technology firms are very, very large, which are involved in many, many activities in many sectors. So it's difficult to think of an entity-based regulatory agency that just regulates all of their activities, because they're so widespread through the sectors of the economy and embedded in our day-to-day. So I think that combination between activity-based regulation and then potentially maybe some entity-based regulation for a broad range of identifiable activities some technology firms may be playing, probably will play out in the medium term.
Often, I think in this world you see these platforms or intermediaries not necessarily themselves seeking a license. You even got some neobanks that don't really have licenses because they kind of tag onto existing financial institutions. They become an extended arm of the transmission or distribution framework. So that makes it even more complicated because, in a way you kind of regulate the underlying product and so on, but it's the front end that escapes regulation at the moment. Last question on this issue is, I think one of the handicaps sometimes for the established financial institutions is the fact that they are treated at group level. You, of course, need to take a look at them. It minimizes the possibility for a bank to explore in the fintech space. So even if they want to have kind of startup companies explore things, ultimately they are caught by the overall balance sheet and by the overall supervisory framework. Do you see any ways which would allow established financial institutions to explore more in this space without it immediately falling back into the Basel framework or all the other obligations that are imposed on a big financial institution?
Well, as you said, when you say big financial institutions, we were talking about banks and bank holding groups, as you very well mentioned. The concept of banking prudential regulation, not other parts of the regulation, but the prudential regulation is on a consolidated basis, on a group consolidated basis. I can't imagine in the short term that would change, to be honest. And I think that has been very much at the core of the regulation, and it will continue to be. Having said that, I think two aspects are important. I think first is coming back to the first part of your question. It's important that we are aware, concerned, and very, if I may say, strict on the potential regulatory arbitrage that may arise as a source of opportunities coming out from technology. I think technology is good, that will provide good services, better services, new services to customers. But if it's just purely used for regulatory arbitrage, so that unidentified risks that are being supervised under a given entity are just moving on to other parts of the system without really being reduced, but just moving out of the regulatory, of the supervised universe, that's something that we need to be concerned about. On the other hand, as you say, I think it's important that banks also have the ability, to engage and compete on an equal grounds when they engage with common activities. And I think they've been doing that in a relatively smart way. They've been developing a lot of joint ventures. They've been engaging with fintechs. They've been engaging in new technologies to try to understand that process. And we should not hamper that process. We should be aware of the risks that they may be engaging and making sure that they account for those risks, because at the end, obviously, ultimately, as I said before, the supervisions are on a consolidated basis. But we should not be hampering them either from doing that.
And I think one good example, by the way, of that is the decision that's taken about IT and software treatment in the prudential rules as a way of encouraging banks to invest in innovation. And congratulations on that as well last year. I think that was a very important measure. Maybe spending the last few minutes on sustainable finance. Obviously, a big issue for the ESAs, a big issue for the EBA. And maybe finishing on a more positive note, what opportunities do you see out of the fintech or digital finance discussions emerge to facilitate the transformation to a more sustainable financing model?
Yeah, that's obviously a very important topic, very, very, very much in the top of the agenda of the European institutions. Let me just start with a reference. The estimates suggest that the finance gap to invest into the transition to a more sustainable economy to meet the EU climate and energy targets, that gap is estimated to be in the range between 175 and 290 billion annually for this coming decade. So that would require a combination of public and private investments, and that is probably, I wouldn't say that it's unprecedented, but it's a very large magnitude that we have not really seen in our generation. Now, for me, the European banking sector plays an important role in financing that transition, facilitating that the money goes to where it needs to go and where it needs to go, and that the appropriate allocation of risks are there. So I think that the banking sector in particular, and probably I can expand this to the financial sector, has these two key challenges. One is to set the strategic objectives, considering the expected shift in policies. Where is it that, given those are the policy objectives, where is that the banks, each individual one wants to be there, with announced targets for their investment on energy and environment. And second, also to incorporate the ESG factors into their governance and risk management framework. And this, we have issued already consultation earlier last year on how to incorporate ESG into governance aspects of banks. I think that's very important. We will issue this first quarter another consultation on disclosure on the ESG exposures, mainly green-related disclosures. This will be early on, probably, I would say, not very precise. We're orientative. We'll leave some room for banks to think about how best to disclose where they are and where they want to be. But I think it's important that that information starts building up. Now, technology here plays a huge role in one of the key aspects as we go forward, which is how do we better build risk modeling and risk assessment techniques for this new environment, because this is a big challenge in which we need to work over the medium term. Banks need to have proper risk assessments, and those proper risk assessments in many ways cannot be built in the old way that previous models were being built on credit and market risk, which is basically, let me take a long time series of history of data of this type of transactions, and from there I estimate PD, LGDs, probability of default, loss given default, and other parameters that may be helping in explaining that well. That's not the way it's going to work for this upcoming ESG risk. We need to think about scenario analysis. We need to think about building more general equilibrium models rather than partial equilibrium models. And here I think technology will play a very, very important role in helping us assess those risks better. And as we go forward, I'm very optimistic that that leap in that technology will really enhance the risk management capabilities of banks in the medium term.
Thank you. I think actually going into the conference next year, we will make much more of this particular issue. And the panel later today will look at data sharing as a precondition for collecting all the relevant information to allow effective risk modeling and risk management to follow suit. With that, I think I really only have the opportunity to thank you again, Jose Manuel, for being with us this afternoon. It's a pleasure as always. As we said, hopefully in person next year. I wish you and your team a lot of good luck and success in the hard work, and we're looking forward to seeing the call for advice around the issues, the analysis of the digital transformation that the Commissioner announced and you mentioned. Thank you very much for being with us. It's a great pleasure and honor.
Thank you for inviting me again. It's a real pleasure, and as you say, I hope to see you in person next year, if not before. That will be
hopefully before, but hopefully also at this conference.
Thank you very much.
Thank you very much.
Bye-bye. Have a good afternoon.
Bye. Thank you.
Bye.